Everyone, welcome to the show. I've been excited about this episode the whole Christmas break, not going to lie. We have today on the show Jordan McNamee. He is the founder and chief investment officer of the newest fund on the block, and that's the Optimist Fund. Jordan, welcome to the show.
Thanks for having me. Excited to chat.
So there's a lot in a name. Why call it the Optimist Fund and not the Realist Fund? We've got to hear it. Let's start off there.
Yeah, that's a good question. Uh, so I focus on growth-oriented companies, ambitious businesses, like some of the companies that I own, like Uber or DoorDash or Carvana, etc. And what I learned from following many of these very ambitious companies is that they're throughout the journey of building the company. Um, there's always going to be insane levels of skepticism at different points in time, and things are going to look weird. Like Uber, like you look at all the articles about Uber early on. Oh, it's valued at 20 billion. It's burning all this cash. This makes no sense. Like this business model doesn't economically work. It will never work. Like all of these, so many negatives and so many things to say why it will never work. Um, and what I realized is that people in general, uh, this has at least been this has been my interpretation of my time on this planet, is that some people look at something and they immediately find all the flaws with it. They immediately shut it down, or it's just like they're like looking for reasons as to why it would be bad. And other people are can look at something and thinking about it from the opportunity, or how would it work if Uber's burning 10 billion a year and valued at tens of billions of dollars. 10 billion a year is an exaggeration. If they're burning a couple billion a year and valued at tens of billions of dollars, and a lot of smart people are backing this company, but we're all just listening to this newspaper article saying it makes no rational sense what they're doing. Well, how would it? Like how would this make complete sense
Mhm.
actually? And so I just realized that like optimism is just like kind of like a rooted thing around successful entrepreneurs. Like I've yet to meet someone who's very, very wealthy from building companies
Yes.
who is that pessimistic type.
Yeah.
All
Or
of
even a
them
realist.
all of them I met is optimistic. And so let's so like you could, if you Google optimistic, realist, whatever, like I in my launch letter, I think I wrote something about like the optimistic realist is like really what you do want is like the idea of like what is today, but have the optimistic lens to realize that like things can change. You have agency to make things change. You can do things can work. Just having that like level of like uh, viewing things as opportunity is valuable. The thing is that the optimist realist or the optimistic realist fund doesn't sound quite as good, and would just be way too ridiculous. So I just went with optimist fund,
I
and
love
so
it.
I call it optimist.
I love it. Like if we look back at the year 2000, you bring up a good point, right, Jordan? There were so many doubters of, for example, Amazon. Amazon was going to fail. Amazon was going to go
Yeah,
bankrupt. It's just a bookstore. It's not going to work
every
out.
great
No
company.
one, every great company today, right? There's so many doubters, more than the optimists. Yeah.
Yes, way more. And again, it's like it's not saying that everyone who's optimistic is successful. That's definitely not the intent.
There's
But
survivorship bias too. Yeah.
but to own like if you look at any of the great performing stocks over the last 20 years, any of the great companies, it would be like there's likely no pessimists that own those companies. Like like by pessimist I mean like the deep rooted person who's like constantly looking for the world to collapse. Um, because it's just not just doesn't really work that way. It doesn't
Yeah.
work out that way. So that's why I love like the element of optimists, and like I love entrepreneurship and following other entrepreneurs and what they've done, and optimism is like the number one trait I would say that I've come away with successful entrepreneurs.
Absolutely. And we live in a world now where ever more than ever before, You have the disruptors, and then you have the disrupted, and it's becoming more exponential, right? Like the cycles are shortening. So, for example, I saw you have your Starbucks coffee cup on your table.
Oh yeah,
That you could argue is a company that's being disrupted. It's not in the fund for a good reason. You're investing in the disruptors. So tell me more about that.
that's true. Although I do love the Starbucks green tea, I drink it every single day.
Okay.
So it's no one's disrupting my expenditures on Starbucks currently. But yeah, I'm always looking for really ambitious companies.
Yep.
So it doesn't necessarily need to be like a technology company. I don't really care, frankly, if the nomenclature is that they're like a disruptor or what they are. It needs to be a company that has a culture of ambition that is doing something novel and unique that will allow them to earn excess returns. And so it's usually just run by someone who is awesome and very ambitious and very talented. And so that's the like when people always say like, oh, what do you do? Are you growth? Are you value? Or whatever. It's like I'm always looking for CEOs that I think 20 years from now there could be a book written about them because they are very ambitious and very talented.
So there's a lot to get into. Before we do, let's learn more
Yeah.
about Jordan. So Jordan, what sparked your interest? The very first spark in investing. What was it?
Oh, the very first spark. The
Yep.
very first spark. So I, when I was 18 years old, I was really into sports, or I was really into sports like as a child. That was what I was obsessed with.
Hmm.
And when I was 18 years old, I got two concussions over the course of a weekend
Oh,
playing football.
yeah.
And then I like at the time, this was I think it was 2008. Um, at the time, the concussion protocol was like go in a dark room and just like be by yourself. So as you can imagine, doing that to it, like having that for an 18-year-old is pretty, pretty depressing.
Yep.
So at that time, it was really like the moment where I was like, all right, I was putting a lot of effort into sports. I'm 18. I just got two concussions. I'm literally lying in my bed for 3 months by myself in pitch darkness. Where are we going from here? Like, what's the next thing that I'm going to focus on? And so that's when I was like, well, I love to compete. That's what I love to do. So whatever I do has to be competitive. It has to be around other people that are trying to beat me because then I get energy from trying to beat them. It's fun. Uh, and then it has to like I didn't grow up with a lot of money, so anyone who doesn't grow up with a lot of money wants to make sure that whatever they do makes them a lot of money if they're
Yep.
very good at it. And I'm that way. If I'm awesome at something, I'm going to pick something where the economic rewards are attractive as well. And so it was what's really competitive and what is financially rewarding, and that's how I came across investing. And so at that time, I started like reading like the Globe and Mail,
Yeah.
and was just reading about business. And then at the back of the Globe and Mail would be all the stock quotes, and all of a sudden you say, "Oh, what's this company doing? What's that company
Yeah.
doing?" And just learn more about that, and then it just like that was like my hook. So then I was like, okay, well, I want to do this. This is what I love doing. This is a passion. This is like clearly very competitive. Like it's just got my attention. So then I figured out what are the good schools to go to for becoming a portfolio manager. And one of my friends, he was he went to Laurier at the time
Hmm.
and was saying, oh, at Laurier, they have this like Laurier Student Investment Fund where like people who went on it are now like portfolio managers at Fidelity and Gluskin Sheff and all these different firms that were big firms, and so I was like, oh, okay, that's what I'm gonna do. So
Yeah.
I went to Laurier and did that.
That's awesome. Fast forward to the Optimist Fund.
Yeah,
Walk us through how you got that set up. I know you raised money from family and friends. Can we hear about the origin
yeah,
story there?
yeah. So after Laurier, I joined a group in CI Financial called Cambridge Global Asset Management.
Yep.
And so we managed about $20 billion, and it was I think we were like 14 investment professionals total. And so I was a tech media telco analyst there for 5 years, and then the last 2 years I was co-managing and then managing a global small cap fund. But the goal was always to run a fund like what I'm doing now, like a
Yep.
more concentrated fund that's really solely focused on delivering exceptional long-term returns and has less of the constraints that typical mutual funds have. And so in 2020, I met my now business partners, Jonathan Blueberg and Sanjay Sen, because of a corporate action that was going on with a mutual holding that we had.
Mm-hmm.
And through that interaction, I realized, oh, these guys, we think a lot alike. I like them a lot as people. They, they care about their family. Like I have 2 kids, they have kids, so we had a lot of things in common. We think about business very similarly, but I have a very unique view of like the type of companies I'm looking at that is just different than what my partners look at, which made it so that if they were to seed me, it was like, oh, that'd be completely complementary to their business.
Yeah.
So there's no reason for them to not be interested in that's what I thought at the time. So pitched them the idea to seed me to get going, and that's how we got going.
And the rest is history, right? So tell us about year one, though. The first 6 months, you faced so much adversity because you launched the Optimist Fund in 2022. The
Yes.
war between Russia and Ukraine just starts. Valuations are sky high because of low interest rates and the pandemic, and everyone and their cousin and their grandma was investing on the Robinhood app. Walk us through the first 6 months. You've basically faced a drawdown of like 50 or 51%.
Yeah.
But you've significantly come back. You're the rebound kid. Walk us through that in the moment. How did it feel? Honestly, Jordan.
That's awesome. The rebound kid. I love that. It felt not good. To put it lightly, like as you can imagine, like I said, I have been kind of working towards this since I was just joining university. So as you can imagine, you work extremely hard for whatever it was, 11 years to finally start your own fund. And then the first 6 months, you have the worst possible start. Like if I were to like have picked a time to start, there's like 5 months in the last like 25 years that would have been worse times to start. So that really was, at the time, annoying. It wasn't annoying from the standpoint that I was like worried about how our returns were going to end up, to be perfectly honest with you. It was annoying because now everyone I meet with is going to think I am, like they're going to be like, what are you doing? Yep. You're down to like, it's just going to be like me trying to make them think I'm not a complete moron, pretty much. So that was just like a huge mental reset for me, where it's like, before I was working at CI, I was doing well. You meet people over the years, and it's like, oh yeah, you told me to invest in this thing 3 years ago, and now it's done really well. And so you have this like level of rapport and confidence, and then you go start your own fund, and you're like, oh yeah, well, my fund's $4 million. It's down 50% in the last 6 months. And this is why I think these names are going to do exceptionally well. But if you were to look on Google or anywhere else, everyone's going to tell you they're either frauds or zeros. So yeah, you want to invest? Like it
was a tough time, right? But it was a blessing in disguise, wasn't it? Because again, you're not the pessimist fund, you're the optimist fund. So it's one thing to invest, but then because you have conviction in the future of these companies, those 2 years you're able to acquire shares at much lower valuations, right? And that's exactly what you did.
Yes. So like we bought some, like I think our lowest buy on Carvana was like $7.07.
That's beautiful. Like who else was doing that, right? Like who was pulling the trigger down there? Like that's amazing. You were, and then it's rebounded to what now? Carvana for sure.
Now it's like 210.
Yeah.
Now it's like $210. Yeah. So yeah, it was like that. That's the thing. Like it's kind of like it was a blessing in disguise because number one, it created a lot of opportunities for us to do well, and so that's why the fund's done really well since inception, even though we've had that horrible start. And then number two, hopefully you think people look at it and be like, oh, this person, isn't just like, he's just not like a blind optimist buying beta. He actually like knows the companies exceptionally well. And that's why when they went down 95%, he was able to scoop them up and benefit from it. Yeah. That's my hope. That's my hope that the conclusion is, but
that's what I love about you, Jordan. Like if you look in Jordan's fund for people watching, you're not going to see any Mag 7, Magnificent 7 stocks, right? You're by no means like a closet indexer at all. You're looking globally. You're hunting in the U.S. predominantly, Europe, Canada,
Yeah.
and you're just picking, companies that in your mind have the brightest future, right? So walk us through the
That are
strategy. You have
underappreciated. That brightest future
exactly.
that are underappreciated.
Yeah, that have these headwinds, but you understand they actually have tailwinds ahead of them. Your average holding period, I think you set out in your presentation, your deck is 5 years. Of course, you have to be in these for longer term, and you have what 15 to 25 stocks. Like, walk us through the portfolio itself, if you can, Jordan.
Yeah, so it's 15, 25 holdings. Every company I buy, I view as a market leading business run by a really proven successful entrepreneur that owns a lot, or a CEO that is similar to a founder in the sense that they own a lot and have been there a while, like are very critical to the strategy, that has a lot of growth opportunities. So I'm not going to be the guy who's buying like a mature telco.
Yeah,
Even if it was a 20% free cash flow yield, that's just like not what I do. Like what I'm good at is like focusing on the owner operators that are very ambitious and really digging into those type of businesses, and then recognizing, oh, people are painting this business with like this particular brush. Does that make sense? Like, let's dig into that deeper, and then you can kind of figure out, oh, right now the business is losing money because of these reasons, but like in Philadelphia, they're actually like minting it. They actually have like 40% margins in Philadelphia, and they've just taken all that profit and opened in Charlotte, and in a couple of years it'll probably be a similar margin profile. So that's really like what I'm always looking for, those type of businesses. Um, and I concentrate on them. So like Carvana, like I said before, is like my largest holding. It's a high teens percentage of the fund today. And my top 10 is like 85% of the fund right now. So it's really like I'm not the guy for like I'm not the guy who's going to comment on like a million different macro elements. Like
yeah,
I'm not focused on a lot of other like high level financial topics. I'm focused on these type of companies that are really underappreciated, that will make myself and my investors a lot of money over the next 5 years.
yeah. And not only are you global, but you're also hunting in small caps, mid
Yeah,
caps, large
yeah.
caps, right? Like you look at companies that are 500 million all the way up to 50 billion. So walk us through that, because some fund managers just pick in certain sizes.
Yeah, yeah, it's a good point. So the reason why I am more flexible in that
Mm,
way is uh, when I co-ran when I worked on this global small cap fund, we would have made more money had we had not had to sell companies that we knew really well, that got above this 10
mm,
billion market cap range. Um, and so the like by having the like really hard categorization, I completely understand. It makes sense from like a business perspective sometimes, or from like an asset allocation perspective, like to give the tool to an investor to reach this market cap company. Like I get that, but from an actual like returns perspective, it for growth oriented, if you're looking for growth oriented companies, it generally hurts returns, um, because you have forced turnover. You end up selling
yeah.
stuff you know really well, that's doing awesome, that hits a threshold, and then you buy something you don't know as well. Um, and so yeah, I have it like right now. My average market cap is about 20 billion,
Yeah.
and I own a company that's 250 million market cap, and I own Uber, which is 140 billion market cap.
Yeah.
So I stay away from that like $1 trillion section. People, I often say I'm like more like mid cap oriented, with just
Yeah.
like flexibility to go up or down.
Yeah. Yeah. Like, imagine selling Nvidia once it reached 10 billion, right? Like, people don't
Yeah,
realize that these large caps can still be 5xers, 10xers, right? And
yeah, it depends on the
you're missing
business. It's
out.
like
Yeah.
like you know what I mean. Like you could be a business that's mature at a billion market cap. You could be a business that's like a startup at a billion market cap, if their real addressable opportunity is like every person on the planet.
Yeah. So let's look at your selection process. So you're really looking for these disruptive companies that are operated incredibly well, that are opening up new markets, could be new technology. What about something that you said in your deck? You said that unit economics is so important. Why is unit economics so important in your analysis?
Yeah, it's exceptionally important. So the unit economics pretty much. So what are unit economics is like the actual economics of providing the good or service of what you're doing on an incremental basis. So you could think of this as like For DoorDash, the unit economics is of like the economics of a customer. How much does it cost for them to acquire a customer? And then how much incremental profit do they make from that customer over time? And so there's a lot of companies that have really good aggregate financial results, um, and they also have to have good unit economics. But on the flip side of that, there are companies with really good unit economics that don't have good aggregate financial results from the standpoint of like a typical quality value investor. And the reason for that could be a few things. One could be scale. It could be that you need a certain level of scale at a consistent unit economics before the returns of on a per person basis actually show through in the aggregate financials.
Yeah.
And so like if you like Uber is a great example. Uber 2 years ago was free cash flow break even. Before that, it was burning free cash flow. So that if you looked at it from an aggregate perspective, like aggregate financial statements, everyone would say, this is a bad business. Doesn't make money, growing, but no money. But then if you looked on from a unit economic perspective, it would be, okay, well, they give a promotion to get someone to download the app. They download the app. Now the app's on their phone. They give an incentive to a driver to download the app. Then that driver brings his car, and now he's an Uber driver. And on a go-forward basis, I open my phone, hit Uber. I generally don't Google, hey, transportation services. I usually just hit Uber.
You Uber
And,
it, right? Exactly like people are Googling it. You Uber it.
yeah, I request the driver. The driver pulls up with his car, and Uber just makes like a commission on what myself and the driver's business arrangement, pretty much.
Yeah.
How is that not a good business? How could that not be a very profitable business? That did just like my brain when I first used Uber, I was like, this has to be an amazing business, like at some point.
Yeah.
And it actually was. It actually was a good business. It's just certain geos. It depends on the geography and its maturity level. So if you're in the period of like having to build up demand and build up driver supply, you're in this like investment heavy period of having to like give promotions to get people to download the app and give subsidies to get drivers to join. And so that's going to cost, that's the payback on that is going to be more than a year likely. But then once you build it up, you have this recurring profit stream that is actually like a fantastic business. So Uber had great margins in some cities and horrible margins in other cities. And so the thesis of like, oh, rideshare is a bad business or Uber sucks because it's losing money. It's like, well, Uber there is good. So which Uber sucks? Like, what are we talking about right now? Are we talking about Uber in Toronto sucks? Because it doesn't.
Yeah.
So it's Uber in this region. That's where it sucks. Oh, why does it suck? Why is it different from Toronto? Oh, it's burning cash right now. Why? Oh, they just launched 2 years ago. Oh, what was Toronto 2 years in? Oh, it was similar actually. And now it's making a ton of money? What? Like, you know what I mean? This is the line of thinking. So that's why the unit economics is so important, because there are businesses where the aggregate doesn't look good. You take the IFRS or GAAP financial statements, you look at the net income line, it's not going to look good. You're going to open it up and say, I don't want that. But then you actually learn about the business and you're like, oh, it's actually a really good business. And they actually have really great returns on where they're investing. But they're investing in a bunch of different areas that are getting captured in different ways. And so you need to like think about how this is going to evolve over the next 5 to 10 years to see like what the financials eventually will look like.
Yeah, you really need a lot of conviction in these holdings. I know you've said before that some of your holdings in the Optimist Fund are some of the most shorted companies in the world. Tell us about that.
Yeah, it's bizarre. Well, Carvana was the obsession with shorting Carvana is something I will never truly fully understand. There's just an obsession from short sellers about, and like frankly, a lot of dealers too. They don't want Carvana to be successful. So there's like other reasons for why people will not want the company to be successful.
Very disruptive. There's a video I think that you shared where the chief product officer, I believe, from Carvana.
Yeah, Dan Gill.
Talk to us about that. Right, it was such a roller coaster. What were some of the
Yeah,
key
so
things?
well, fundamentally, Carvana is a really attractive customer offering.
Yeah.
The used car market has really been the same for decades. The real
Yeah.
change was Auto Trader going from magazines to the internet. But it's the same thing. You open it, like you're looking for a black Honda CRV with tan interior. You look in the neighborhood, oh, these are the kilometer ranges that I want. Okay, there's like 4 options. This one's this price. All right, what dealer am I going to? All right, that one in
Yeah.
Mississauga. Okay, that's where we're
Yeah.
going. Let's everyone get in the car. We're gonna go buy this car. Like that's pretty much the process. And like half of people that are buying a car at a dealer are only test driving one vehicle, right? So really like the buying process is actually done in the search. Like the idea of everyone like going around test driving like many cars and whatnot is it's just actually not true. It's just not how buying works. And so they have this view of like, okay, well, what do people not like about the dealer experience? Well, they don't like dealing with all the salespeople
Hmm.
and how it's just takes so long. You go to buy a car, if you had a bag full of money, you still can't walk off the lot because you got to go through all the different processes. And so you have the salespeople for the car, and then you have the finance people that are selling you loans and warranties and all these different financial products. And so, I mean, it's a great experience for some people, but like on balance, most people want it to be more convenient, and they don't want to feel sold to, and they don't want to feel uncomfortable of like, should I buy this warranty? Should I not buy this warranty? This guy's selling it to me really hard. Am I getting ripped off? Like people don't like it. So they were like, let's just make it all automated. Let's just make it so you can do it with your own fingers on your phone or on your computer. Give all the information, have a really good online platform that shows every negative about the vehicle that like we want to be overly transparent about. So people trust it and are like, okay, this is the car I want, hit buy, and they're willing to transact and then have a 1 week return policy. And so they first launched in Atlanta in 2013 and realized, oh, people really like this. People are good with transacting online, and it will be a good economic model because we'll have less people. We won't have all the sales staff. It'll fundamentally just be more centralized and more self-serve on the customer, which will be a better customer experience and a better economic model. But they have to build up material scale before the economics actually really will make a lot of sense. Um, and so yeah, this company's just been hated forever because when you launch, like they actually need to buy cars. They have to build out in different regions. Like if you launch in Atlanta, you're not going to launch in Atlanta and be selling people cars in Seattle because you're not buying a Honda CRV and shipping it from Atlanta to Seattle. It's just the
Yeah.
transport costs will be too high. And so you got to regionally build out, and to regionally build out means you got to hire people regionally. You got to market regionally. You got to make upfront investments um, that will make it so that the business is going to lose money at first.
Hmm.
And so when they went public, it was like negative 30% EBITDA margins, growing 100% a year. And then by 2021,
Hmm.
it was roughly EBITDA break even, um, and the second largest used car dealer in the United States. And so people at that point were like, oh, well, going from negative 30% EBITDA margins to break even, you're only going to do that if your old markets are really profitable because you need to get scale on those older markets, right? Like that's how you're getting that margin improvement is from the old markets scaling.
Hmm.
And so Atlanta, their oldest market, had over 4% EBITDA margins in 2021. So the economic model
Yeah.
of selling cars online, in the way Carvana had done it, was proven. It was proven on a regional basis. Like it was very, very clear. If you talk to them, you went through all the data, very clear. This is an economic business. That this management team is really high caliber. All of that was very clear. But then 2022 happened. Interest rates went up.
Yeah.
They were planning to grow much faster than they ultimately were going to grow. And at the same time, they wanted to buy a company for several years that finally was willing to sell. And they decided to take out $3 billion of debt to buy that company. And all of a sudden, everyone abandoned them completely. And the more the stock went down, the more it was obvious that they were screwed. And that just never made sense to me. They had a lot of liquidity.
Hmm.
That they had a couple years to right the ship and like get costs back in line with where the revenue of the business was. Um, and so yeah, I obviously was speaking to them very closely, and everyone was saying this business sucks, and there's all these different articles I can point to that was literally saying factually inaccurate statements about Carvana at the time. But yeah, they did what they said they were going to do. They already had shown, like they already knew the business model was profitable on a regional basis, and now they had too much cost for their current revenue, so they had to adjust the cost base. And so
Yep.
that's what they've done the last 2 years, and now it's the fastest growing and most profitable used car dealer in North America for sure, probably in the world. Um, and yeah, it's a great company run by great people, and there's still a lot of short sellers trying to throw shade on them, and they can do what they're going to do.
Yep.
That's just I don't have control over that. So
A market's a market, exactly.
yeah, exactly.
Um,
So
yeah. It just goes to show it's so tough being an optimist, right? But we've done it. DoorDash is another core holding. Can you talk about DoorDash for us and why you like it?
yeah. So the food delivery market is inherently it was one of the on one of it was an online it was a market that was still predominantly brick and mortar, as you can
Mhm.
imagine. People go in, eat the food there, or they go and buy, like McDonald's. You go and you wait in line and you get the food there, right? So when I had looked at it like years ago, it was very interesting and clear that there was a lot of opportunity for delivery to increase in its penetration, and there was several companies, DoorDash being one of them, that was focused on enabling that.
Yep.
What makes DoorDash unique, and why I own it, why it's such a great business now, is that they in particular focused on suburban markets in the United States. And so the U.S. as a country is a very chain-heavy country. So as you can imagine, thinking about all different chain restaurants, most of them do not have delivery. So versus if you went to like Europe or a different area of the world, like a lot of the independent restaurants actually already had a delivery service. It was a
Yeah. It was
guy.
only the pizza joints right across
Yeah,
North America and Canada
yeah.
that,
In
that
North
really
America,
had
it
their
was
own
really
delivery. Yeah.
pizza,
Yeah.
independent Chinese,
Yeah.
independent other like southeastern
Yeah.
Asia type restaurants.
Mhm.
And so there was this huge opportunity to like enable delivery for everything, all the burger joints, all the different food types.
Mhm.
And DoorDash recognized this opportunity and was building out the business. Starting in Palo Alto was the first place where they started, which is a suburban area.
Yeah.
It's not New York, it's not
No.
Philadelphia. And starting in those markets is like you can only start if you start with delivery. Like they're enabling new delivery. It's not saying we're going to take someone who was calling the Chinese restaurant and getting a delivery to doing it on their app. That's not the
Yeah.
conversion that's happening. It's literally saying right now you only buy Chipotle when you go to Chipotle. Now when you're like, "Oh, I want to get delivery," Chipotle becomes an option. And so that was like clearly a big growth opportunity, and they were early in focusing on that really tough market. And so it was a really hard business, though, really tough business, because you had to
Mhm.
get density on your drivers, because you need to bring together all the drivers, the restaurants, and the consumers. So there's three different constituents that you need to have there. You need to convince the restaurants, you need to convince the drivers, and you need to convince the consumers. And so building that up on a regional basis was like operationally very challenging, costs a lot of money. So the business has burned capital for many years. But once you actually build out that network,
Yes. The network effect.
once you build out the
It's
network, you
yeah.
have a business so that on the increment is now going to make a lot of money.
Yeah.
Just like if you built out if Visa wasn't like a co-op between banks,
Yeah.
um, if it just started day one, oh, we're going to start a Visa network, that would be very expensive to build out that network.
Mhm.
And so DoorDash, like the concept of there being like a major player that would be like that network, bringing all those three parties together, was very clear to me that there would be like a very attractive business. And DoorDash was just clearly like the best executor and the leader in the US, which is just an enormous market.
Yeah.
So that's what I love. I love DoorDash. It's a great business. The founder owns a The founder owns a very large stake in the business. He's
Hmm.
exceptional. They still have so much growth opportunity. Like, if you think about e-commerce broadly, like what percentage of e-commerce do you think is delivery within an hour? Very low.
Yeah.
Like when you buy something on Amazon, you don't get it delivered in an hour.
Yeah.
So what e-commerce? The next question: what e-commerce is delivered in an hour? It's food. Like
Yeah.
it's the stuff. The only thing you would buy is food, right? So like Uber Eats is the same. Like these on-demand delivery networks are like the delivery networks that can deliver stuff within an hour.
Yeah.
And so food has huge runway. But then if we think about like what other things can 1 hour delivery, what other leverage can be added to 1 hour delivery? Over time, it could be a lot of stuff.
Yeah.
Over time, it could be the norm to just get stuff in an hour. And
Sure,
if
it could
that's the
be
case, that'd be great
parcels,
for
it could be
DoorDash.
pharmaceuticals, it could be everything under the sun. And the beauty about DoorDash, it's very sticky. These, especially these smaller restaurants, they rely on DoorDash now. It's
Mhm.
opens them up to discoverability. Like DoorDash is the search engine for restaurants, basically, right? You go in there if you feel like Chinese, maybe you'll find the Chinese restaurant that you never even drove by.
Yeah,
And sure enough, the restaurant's opened up a whole new market they never had
it
before.
it does. And I've been a DoorDash delivery person because I love to have little adventures learning more about my companies. So like my delivery experience also like makes you realize how many opportunities there are for incremental like just little incremental elements that will make DoorDash an even more valuable company.
Yep,
Like the network getting denser and denser
yep,
matters a lot. Like it's pretty much most DoorDash people. It's point to point. Like you
yep.
go into this restaurant, you pick up one order, and you drive it to that person's house. Be great if three people on that street ordered from this restaurant. It'd be awesome. And conversely, I understand the economics, some delivery economics, where I'm like, nah, this does not work because
Yeah.
I almost threw out my back for $4.
That's the best kind of stock research. I think you'd make Phil Fisher proud, right? Like you're literally delivering for DoorDash. And the founder and CEO still does it this very day. He encourages his
Yeah, every
employees,
month,
like go
every
out
once
there
a
and
month.
deliver food. Yeah.
Yeah, it's great. It's honestly great. I love doing stuff like that with my companies
Yeah.
because or even companies that I don't own. Just like learning about a company from that intimate level, you just start to
Yeah.
realize like, oh, like if I were to hate you, these are some of the reasons. You know what I mean?
It's so true. And, there's an investor I talked to, and his last question he asks is, would people be upset and disappointed and angry if this business went away? And I think in the case of Uber Eats and Uber and DoorDash, people would be pretty upset
Oh
if
yeah,
those apps went away. They
that'd be
disappeared.
oh yeah, that'd be a nightmare. I mean, I remember for a lot of people, it'd be a like Uber, like and you can like the ride share. That's what's funny when people talk about Uber ride share. Oh, it's horrible. I can't believe I spent $75 to go to the airport. Call a cab then.
Yeah.
Do that.
Yeah. Good luck. Yeah.
Like they're just matching supply and demand
Yeah.
with a very convenient interface. Like, do you
Yeah.
remember cabs? Cabs were horrible. I remember one time getting a cab from a wedding in downtown Montreal, and I didn't have cash. They drove me to a random ATM. Like, it was like 2 a.m. taking out $200 cash at this like random ATM because he would not take Visa. Like, people forget. Like, people forget how brutal dealing with cabs was.
It was pretty horrible. You never knew who you're gonna get, who the driver was who pulled up.
Like,
Okay, so
how is it their payment was always out of business? Like they could never take credit. Like the
of
credit
course, like
machine
it
was
had to
right
be
there. They
cash,
could never
right?
take it.
And then as soon as you walked in the cab, they'd already they clocked you. It was already $5 like on the meter, right? What was going on there? But yeah,
Yeah.
the whole industry needed to be disrupted. So we walked through Carvana, DoorDash, Uber. Tell us about HelloFresh and what excites you about the meal kit
Yeah.
business.
Yeah, HelloFresh is a really interesting one right now because they have like it's like a really interesting last 5 years for this
Yeah,
company. So like most of you probably know HelloFresh because there was so much marketing around meal kits during the pandemic and even before the pandemic. But HelloFresh was like founded in Germany. They're the leading meal kit business in pretty much every Western country. And pre-pandemic, the business made economic sense on a geographic basis. So like Germany, their oldest market, was generating, strong margins. Like it was clear that direct to consumer meal kits, if you're the leading player and you reach a certain scale, like it's a profitable, attractive economic model. And so they obviously they started in Germany, and then they went into like every other country that was a developed country. And so they were on this path, growing really well, got to EBITDA positive on an aggregate basis. Then the pandemic happened, and it like made their business just go insane. So it was like, it was growing at 40 to 50%. Now it's growing at 120% at like very attractive incremental margins immediately, because there's nothing they couldn't spend anymore.
Yeah.
And so the business went all of a sudden to like doing exceptionally well. They had like 13% EBITDA margins, generating tons and tons of cash, just way more customers. Everything was good. And so that just took the business and made it more mature, much faster. But at the same time, where they were doing incredible, they also bought a business called Factor 75, which was a ready-to-eat business.
Mm-hmm.
This was a very small business at the time. It was doing like under 100 million of revenue. They bought that because the idea of what HelloFresh would be as a company was like a food solution business, where they don't want to just be meal kits. They want to offer other types that could make sense for customers, but still be within their direct-to-consumer model.
Mm-hmm.
So they bought that business and then have scaled that dramatically over the last 4 years to now it's like 2 billion in revenue run rate. It was 100 million when they bought it. So 4 years, 100 million, 2 billion. Huge growth.
Yeah.
But over that time, the meal kit business, as you would imagine, COVID, there was a reopening. The meal kit business had some customers that were not sustainably going to stick with them. And so the meal kit business started to decline while the ready-to-eat business was growing a lot. So the aggregate business went from like growing like a weed to then all of a sudden it was like flatlining for the last 18 to 24 months, roughly. And the stock did poorly over this time. It went from like a $95 stock to like a 95 euro stock to like a 20 euro stock. And it got obviously caught up in like the growth hype period of like 2022 correction. So that was the same old, but overall, if you look at like them versus other COVID beneficiaries, they were still actually doing really well. They were still dominating. They have 80% plus market share in all their markets, beating their competitors. They're still in a good financial situation. And then it was like last year, 2024, where it's like, okay, now they should get back to growing and things should, this like consolidation of meal kits declining while ready to eat grows. The meal kits should start to grow again, and ready to eat still growing. So there should be this like, okay, we're coming out of this consolidation phase and we're going to grow a lot more at good incremental margins, and the business is going to take off. So that was the view going into the end of 2020, the end of 2023. And then they had 6 months of like literally the worst things that could have happened to them. Just absolute complete screw ups that made every investor be like, really? Like, then, and just completely abandon them. So they had their one facility. So it was two elements, one on the meal kit side, one on the ready to eat side. So on the ready to eat side, they were opening a facility in Phoenix that is the second largest commissary kitchen in North America.
Oh, wow.
It's second to Disney World. So they're opening this facility at the end of 2023, and the scaling of that facility was much more challenging than they were expecting, which was going to make it that instead of doing a mid-single-digit EBITDA margin for that business, it was going to be a negative mid-single-digit EBITDA margin. So that they took it on the chin on that. That was like, okay, we have more startup costs than we expected, and then at the same time, the meal kits business was more growing or declining, still declining, not growing as fast as they had hoped it would get to. Like they were hoping it was going to get back to being flat. It was still declining, high single digit. And so releasing this information over the span of this 5-month period of November to March made the stock go from like $28 to 7 or 28 euros to 7-ish euros. And people were like, I'm out. You guys are idiots. Like, you don't know how to forecast your business. The meal kits is going to go to zero. Ready to eat isn't making money. Like, patience over. And so it literally got so at its low, it got to as low as like €4, 4.5
Oh,
euros.
yeah.
And at that moment, it was like 2 times EBITDA with net
Oh,
cash.
wow. Yeah.
So it was like people were like, I'm out. Like, this EBITDA is make believe. It's gonna get cut again. It's gonna be brutal. It's gonna be horrible. But so it was like a medium sized position for me going into that disaster situation. And
Hmm.
this disaster comes out. It's like, oh, okay, this is not ideal. Let's figure out, make sure this is like transit. Is this transitory, or is there actually something going on here that is mean I'm gonna have to exit the position? So then, digging much deeper, speaking with the company, and then digging into all the different claims that they said
Hmm.
why the problems are. My conclusion was that, the ready to eat element is purely transitory. The margins will
Hmm.
get back to mid single digit within the next year. So that will get fixed. And if it didn't, it would mean that people, for some reason, are no longer going to value getting food, like paying for ready to eat food, which is actually like a pretty established industry, which is just something I would bet against.
Yeah.
So there was that, and then there was the meal kit business, where it's like, okay, maybe the meal kit business is in secular decline, and their inability to forecast it is really not good. And so why don't they just give up on thinking it's going to grow? It's okay if it's in decline. That's fine. Just milk what they have today, take that capital and deploy it in a positive ROI business initiative. Maybe that's ready to eat. Maybe that's a different business. And so going through the details of that scenario, what was clear was they had finally accepted, we're not going to try to grow the meal kits business double digit. We've accepted this is a mature business, and we are going to focus on maximizing free cash flow per share that comes from this business. And so the shift of that, along with my confidence in the ready to eat business being structurally very profitable, and they just need to scale into this new facility, is what made me realize, holy, this is a very cheap stock right now. So then I bought a lot more. And now they're focused on just maximizing free cash flow, which I think they're going to generate a lot over the next couple
Yeah.
of years. While they're stabilizing the meal kit business, focus on enhancing margins, and the ready to eat business is doing well, and the margins now are mid single digit. And might I add, the CEO just took out a 10 million euro loan in September and bought more stock personally. So he went from owning 4% of the company to roughly 5% of the company.
That's bullish.
And they bought back 6% of the company in the last year too,
Yeah.
while this was happening. So yeah, that's the HelloFresh situation. Like, right now, it's still like 3 times 2025 EBITDA on what I think
Yeah.
they're going to earn. And so I think EBITDA is going to step up dramatically this year. And if you just put a grocery store multiple on it, it'll be a 25 to 30 euro stock, and it's whatever, 12 to 13 euros now. But if you really think about, like, oh, this business should be, even if meal kits is declining over the next several years, and the ready to eat business gets as big as meal kits over time, which there's no reason why it shouldn't. I think it actually will be much bigger than meal kits over time. But even if we
Hmm.
just assume it gets to meal kits, in aggregate, it's gonna be it's gonna be a mid to high single digit aggregate business with 10% EBITDA margins,
Yeah.
and that is going to make it so that free cash flow goes from just marginally positive to like 600 million euros of free cash flow in 5 years, and it's a 1.5 billion euro company right now. So it's a lot of
It's
upside.
just crazy to think it was another company where people were throwing in the towel last year, thinking, "Hey, it's going to go out of business." But uh, people want healthy food, but they want convenient food still, right? So
Yeah.
it's becoming more of a norm. This business model.
And you need
Talk
to
to
be
us
big.
about
You got to
yeah,
be big. You got to be big. A
yeah,
lot, like, it's to say, you look back to Amazon in the early 2000s, like
yeah,
online business models, you have to be big,
yeah,
and it costs a lot to get big.
yeah,
But then once you are big and all these
yeah,
costs are in, the incrementals from there then can be very attractive. And that's
yeah.
what I think is going to happen with this name.
Then you almost become a monopoly, right? Because you have so much market share at that point.
Yes, you should. Well, you should, because no one
Yeah,
else is going to compete with you in this model. And like with meal
yeah,
kits, every grocery store got into the meal kit business because it was like, ooh, or what are you doing in meal kits? Oh, okay,
Yep.
we'll buy a meal kit company. Then they had it for a couple. They typically what happens is they had it for a couple of years, and they're like, this is a distraction from our core business. Meal kits is like such a niche. Let's just focus
Yep.
on our online business.
Yep.
So
That's
that's
a
that's
beautiful
why I
thing.
think HelloFresh could be like this like really dominant niche company that that stubbed its toe severely,
Yep.
but is structurally a good business, and I also think that the management team actually is high caliber, even though they made a huge screw up early
Yep.
2025 or early 2024.
Yeah, so we've talked about a handful of companies here. Those would be your highest concentration that are basically household names and becoming
Yeah.
more so. Um, but we missed one, Wayfair. Wayfair has a pretty bold vision in the furniture business and the household business. So tell us why you have so much conviction around Wayfair.
Um, so I like the founders a lot. The two founders have been building an online furniture retailer for over 20 years now, and they have done a really good job and built Wayfair up to being a household name,
Yep.
largely through a better customer experience. In it, like on average, we can always find nuances why one person was better, but on
Hmm.
average, it was a better customer experience. Why is that? Because if you go to a furniture store, they are if you want a black leather couch, they're not going to have 1,000. It's just they can't do it. The furniture business is a showroom business. They're going to have a bunch of couches in this showroom. You're going to say, "Oh, I like that couch. All right, can I buy it?" They'll say, "You sure can. Give us 50% down right now, and we'll charge the other 50% when the couch gets to your house, which is going to be 2 to 3 months from now." Which pretty much sucks. Like that does suck. Like
People
when you
want
think of it,
things
like
now,
especially when
right?
you're excited too. You sit on like a nice new couch. You're like, this is like I can't wait to sit watch football on
Yeah,
this couch, and then you're just like,
exactly. Sipping on a nice beer, right?
yeah,
Wine, whatever it might be.
2 to 3 month wait. So that is the industry. And so what did Wayfair do? Wayfair just brought significant selection, a significant selection and search advantage.
Yep.
Really, like that was the initial. It was just you're right now looking at 10 couches. We're gonna let you look at 20,000, and that
Yeah.
was just plugging into all the suppliers, but like tons of suppliers globally to have a selection advantage. So that was the basic. But they evolved over time, recognizing that okay, we need to have a bigger moat than just that's effectively like a merchandising and like it is a selection moat, but like it can be replicated because they actually don't hold the inventory, so it's really just connecting with all the suppliers. So what they did is they said, okay, how can we differentiate ourselves even further?
Mm,
Let's invest in logistics so
mm,
that 2 to 3 month
yep.
delivery time is now shorter. Um, and so they spent a ton of money in logistics over the last 8 years, um, which made it so that they were roughly like free cash flow neutral for
Hmm.
most of the history of the company, but negative net income, as you'd imagine, as they were just acquiring customers and then investing a lot into logistics. So investing in logistics has made it so that of a large percentage of stuff on their site, you can get delivered within 2 days,
Yeah.
which is a big deal. And even
Yeah.
like if you just look at a couch today, like you can get a lot of different couches delivered in a couple days or a week
Yep.
or 2 weeks. There'll still be some that are going to take longer because it's specific to maybe it's a custom couch or something specific to that supplier. But in aggregate, it is a differentiated customer experience. So this allowed them to grow a lot, and then COVID happened, and they grew a ton
Yeah.
initially, and then the opposite of COVID happened, which is now no one's spending on home goods at all. And so the industry now has been in a depression pretty much for 2 years. And so it's been declining like double digits for 2 years, and Wayfair has been roughly flat, like flatlining effectively. And at the same time, focusing on just getting much more efficient, getting rid of excess costs, which I think is going to poise them for when there is a recovery. People are going to be surprised with how profitable Wayfair actually is. Because they have a lot of fixed costs today. They built out this differentiated logistics. They have this leading platform. Uh, they just now once they grow 10% again, that's going
Hmm.
to flow down at very attractive. margins, and people are going to say, "Oh, wow, this business will be able to generate billions of cash in the future if they
Yeah.
keep this trajectory." But we're just like we're trough multiple in a trough market right now.
Becoming a market share leader takes time. Have you noticed like companies like Wayfair, even a company like Costco, there's always these little blips on the stock chart where there's rumors of Amazon entering the business. Amazon's
Yeah.
going to enter the furniture business. Amazon's going to enter the warehouse business, wholesale business like Costco, and
Yep.
you get like a small drawdown. But Amazon can't do everything, right?
Well, they can't
So
have 100% of every market, that's for
yeah,
sure. So,
yeah,
like with Wayfair, like Amazon is 100% a major competitor to Wayfair,
hmm
and they are a good competitor as well. The home goods market, though, is really,
yep,
really fragmented because it's pretty much an add-on market to every general merchandise retailer. And so there's just so much. There's just such a big pie for Wayfair
yeah,
to take share from that. Like it's not they have to kill Amazon for Wayfair to be successful.
yeah,
Like literally, like right now, the stock will do well as long as as long as the furniture market grows at some point again. So if we permanently have a minimalistic society where we're not buying chairs, couches, and whatnot, pillows, which I would bet against, given how many pillows are my wife constantly buys, um, then that would be negative for them. But the market will come back and they will grow faster than the market and show really strong incremental margins. And then
yep,
people will be like, oh, this business is going to be economic
hmm
and it's not this crappy business that's just been throwing money out the window.
yeah. So I'm going to run down the rest of your holdings here, Jordan. I have a snapshot in front of me from the fund itself, and if you can maybe pick, two or three that you want to explore further
Sure.
for the audience. You've got Revolve, which
Yeah.
I've honestly never heard of. ACV Auctions, Monday.com, Latham Group, First Advantage, ThredUp, Fiverr, Collier, DSV, Teledyne, Goosehead, Ashted. Can you maybe talk to us about a few of these that, the majority aren't household names?
Yeah. Sure. All right. Well, let's do Latham Group. They make fiberglass pools.
Interesting. That's niche.
Yeah. So they have like over 50% share in fiberglass pools.
Yeah.
But as you would imagine, the last couple of years have not been overly good, to
Yeah.
put it
No
lightly.
one's drawing on their
Or
line of credit, right, to
exactly.
replace their pool with a fiberglass
Everyone
one.
who was thinking of getting a pool is like, my home equity line of credit right now is pretty expensive. My aspiration for the pool that didn't go away, but we should probably
Yeah.
wait.
Yeah.
So new pool starts went from about 120,000 pools a year in 2021 to about 60,000 in 2024. So the industry got cut in half. And Latham went public at the peak of the industry. It was private equity
hmm
owned. Made
hmm
sense why they'd go public at that time.
Yeah.
Stock was $30. They were earning a lot of money. It's an attractive business. They've been gaining share over time, and there's a share capture element of like fiberglass
hmm
versus cement and vinyl pools. Like there's a benefit to fiberglass, which is making fiberglass take share of the aggregate market.
hmm
So it was a very interesting investment thesis at the time. I actually wasn't following it at this time. And then they had a horrible 18 months. Stock went from $30 to $2,
Oh,
and that's when I came across it. I came across it actually from another Toronto investor. I was looking at his 13F, and then I saw this company. I was like, oh, I've never heard of that. And
interesting. So it was like a clone pick that
clone pick,
Monish Pabrai might say, right?
100% clone
Clone
pick. Yeah,
investing. Yeah.
yeah, pure theft, pure
Yeah.
theft. Um,
I love it. Yeah.
And so, yeah, so when I dug in at that point, I was like, oh, this is an interesting business. Like,
hmm
it's had historically good returns on capital. Management team owns a good slug of equity. They've actually like made good decisions, in my opinion.
Yeah.
But the market, like interest rates soared,
hmm
market pulled back,
Yeah.
and now we are paying like a trough, like profitability got cut in half, and the multiple went to like 4 times EBITDA.
Yeah.
So I'm like, and it had like 2 turns of debt too. So it was like, oh, there's some leverage here, but like
Yeah.
it's 2 turns now on EBITDA that got cut in half. So it's and they had a lot of inventory too. So their actually free cash flow was quite a bit higher because they were destocking.
Hmm.
So it was like no balance sheet issue. They had been like a 10% organic grower pre this because of the pool industry pretty much grows at like 3 to 4% on a unit basis, and then a couple points of price. But then they have this like market share gain element from fiberglass pools becoming
Hmm.
more popular. So I was like, oh, this is an interesting like business that has like structural growth characteristics and attractive financial profile on a normalized earnings stream that's set an absolute like horrible cyclical trough on a trough multiple.
Yeah.
And so that got me very interested. So I did a bunch of work, spoke with the company several times, and then started building a position. And so now I think we're in a situation where like uh, on like a per capita basis, there has not been this few amount of pools being created a year,
Hmm.
as far as back as the data that I've been able to find, which is like 40 years. So this is worse than on a per capita basis. There's less pools getting put in today or the last 12 months than there was at the bottom of the great financial crisis, where home equity values, just like got decimated.
Plummeted. Yeah.
Plummeted. So
Like,
people's financial situation in
yeah.
08 and 09 was
Yeah.
way
Yeah.
worse than it is today.
Yeah.
But the amount of pools getting put in is the same amount.
Interesting.
So I think we've troughed from that perspective.
Hmm.
And so over the next 5 years, if we mean revert to, 80 to 90, 80 to 100,000 pool starts a year, and they keep gaining share because of the benefits of fiberglass, the profitability of this business is going to absolutely explode, and we're not paying a very big price for that explosion of profitability. So I'm really excited about this name. Bad case scenario, I'm kind of saying the same thing a year from now, and
Hmm.
we're still waiting. Like we're still waiting for the. This is the same thing with Wayfair, frankly. It's like,
Yeah.
in my view, the bad case scenario is a year from now. I'm saying the exact same thing, and we're just like, when is the market going to turn? But their core like value prop and their positioning in the market should be the same. Um, and good case scenario, like the market has turned, and now people can start thinking like, oh, 5 years, like 2 years from now, like the incremental margins are going to be very attractive. You all of a sudden start thinking further out than next quarter, and these stocks are very, very cheap.
Hmm.
So yeah, that's the Latham thesis.
Yeah.
And then ThredUp. ThredUp is an interesting one that had a very interesting announcement yesterday,
Okay.
actually. So ThredUp is a marketplace, a managed marketplace
Hmm.
for used clothing. And
Hmm.
so there's a lot of marketplace apps where people sell used clothing, like a
Hmm.
Poshmark or a Depop, or even if you just go on like Facebook Marketplace or people's Instagram accounts, or people are selling used clothing. Um, there are not other companies that actually do all of the selling process for the people that have the clothes, which is what
Hmm.
ThredUp does. Let me explain that. So, like, for me, if I wanted to sell this sweater,
Hmm.
I would obviously take it off. I'd put it on a bed or something, take a bunch of pictures, take pictures of the front, take a picture of the back, throw it up on a website. I'd say this sweater, this size, this condition. Then I post a price. Now I'm gonna get stink bitted for like a couple days. Like, oh, I'll give you $1. I'll give you. Like, you just get harassed by stink bits, right?
Yeah.
And then you gotta figure out, oh, okay, I'll do this. Oh, okay, oh, screw it, I'm not gonna buy it. So you go through this whole process of like trying to sell the item. Then you do sell it. You print off a shipping label.
Yeah.
You put your thing in a little bag, or whatever. Throw the label on. Throw it in a mailbox.
And at that
And then
point, you're thinking, I should have just dropped it off the Valley Village.
yeah, and then you're like, okay, did I literally just do all this to make $10? Like this is horrible.
Yeah.
And so people generally, like the people who are selling clothes online, are usually resellers
Yeah.
that are hustling. So they're focused on just doing this. They're aggregating other people's stuff,
Yeah.
and then they're selling it, because this is actually like a business where you got to be like efficient to make more than half of minimum wage. And so Your option is, so what do most people do? Most people, their closet fills up with stuff,
Yeah.
and then every year or a couple of years, depending on the person, they like see like, oh, I don't wear this, don't wear this, don't wear this. All right, put it in a bin, take it to Value Village, or take it to a
Yeah.
Value Village equivalent.
Exactly.
So that's the majority of the industry. So what ThredUp decided they would do is like they could do an online process where they do everything for you. So they send you a bag.
Oh.
Just fill the bag. You just fill the bag with what you don't want, and
Yeah.
that what you want to get some money for, and
Yeah.
then you send the bag. That's it.
So it's as easy as dropping off at Valley Village or Sally Ann, but you get paid
But
at the
you
end of
get
the day.
paid something, yes.
Yeah.
And so what does ThredUp have to do to make that happen? This is the element that's interesting about the company. Why I always followed it, but only recently owned it. But I
Mm-hmm.
always followed it because it was no one else was doing this. So what do they need to do? They need to pay for the logistics
Yeah.
of your bag coming to a warehouse facility
Yeah.
where there's all these bags getting sent there. They got to open the bag. They got to look at what's in this bag. Oh, okay. There's this. This is a piece of garbage. Throw that out. This, like, they got to sort through it, figure out what's sellable. Oh, okay, half the bag's sellable. The other stuff's not sellable. Okay, half the bag's sellable. Now we got to actually sell it. So let's throw it on. Let's take a bunch of pictures from it, identify what the flaws are, make sure it like doesn't have, make sure it's like doesn't have, isn't like covered in mud or something like that. So
Yeah.
you just throw that in.
Mothballs and
And so take a picture, merchandise, put it on the website, figure out what should we sell this for, and then not only that, you have to hold it, store it, while you're waiting for it to sell. And if you think, what is the difference between this business versus every other e-commerce business, for the most part, is that you go to Amazon, there's SKUs, and they might have a 1,000 of the same SKU. You know what I mean? One Xbox is like you could have 500 of the exact same thing. So if someone buys it, it's like, okay, give them one of those, but we have multiple. This is different. There's one of that exact sweater. So if you have like 5 million items, you have 5 million unique items that when someone goes on the website and says, all right, I'll buy that for $30, you got to find it in this warehouse and bring it down, obviously, then package it and ship it out. Yeah. So that they've had to build this whole like logistics that they've built is all custom to their business, and they're
that's
the
their
only
competitive
ones
advantage. It's a very high barrier to entry. It's not like anyone can just say, "Hey, I'm going to open this up now."
Exactly, and no one did it. No one's done it but them, because everyone looked at it being like, ugh, that's the tough business. And it went public in 2021 at, as you'd imagine, very big price, was growing a lot. They were making a lot of investments that may or may not have paid off in the next 10 years, but regardless, they were spending money now that they weren't going to see a commensurate return very near term. And so when 2022 happened and all growth-oriented companies, people were like, show me free cash flow or I'm out, they all said their stock collapsed, and then they were like, all right, we got to like grow into our existing business. Yeah. Like we need to, we knew we had positive unit economics, but like we need to stop spending for the next 5 and just like grow into what we've already built. Yeah. And so from 2022 to early 2024, they did exactly that. They grew into their existing facilities. Their margins went from like negative 30% EBITDA margin to roughly break even, and so that implied like a 30 to 40% incremental margin. So it was like, it actually, the last 2 years really was like, okay, this business does work. Like it is like, people will pay for this service. They can monetize this service. It does work. And now they're at a point where incrementally scaling is going to all of a sudden show up in like attractive cash flow because they got to this break-even point. And so they got to this period, and then in the last year, this is going to sound the exact same as the HelloFresh situation, by the way, of like they did this heavy lifting, they got through all these challenges, and then they stubbed their toe on 2 things that are just like, people are like, I'm out. I can't wait for you anymore. And so this past summer, two things happened that that really screwed them at the time. Was number one, they had an international business and a U.S. business. The international business was roughly 20% of revenue, but a much, much lower percentage of gross profit. They had bought it in the height of 2021, frankly. It was a different business.
Yeah.
And the U.S. business was now at like cash flow positive and doing well, like earlier in 2024. And it was just the international business that was like the drag still. But the plan was like, okay, we got to get to good cash flow and show that this business model works. They changed managers of the international business in the middle of 2024, and the new manager came in and said, yeah, like you're forcing something it's not ready to be there. Like more capital needs to be put into the international business right now, not less. Like it's just not at a point that the US is where we can focus on like growing the cash flow generation of the aggregate business. And so that didn't vibe with the plan that they had in place. They said, we're going to scale margins now. And this guy is saying, oh, on this part of the business, you actually got to like re-up the investment. So that sucked. At the same time, they made a marketing adjustment to how they market to new customers that took 3 months to really identify how successful of this incremental change was. And they frankly just allowed it to, they rolled it out too broadly. They took a risk pretty much. They said, okay, we're going to find out if this works much faster if we roll it out broadly. If we don't roll it out broadly, roll it out incrementally, we'll find out over the next year if this is a good idea. If we do it broadly, we'll find out in the next 3 months. So they're like, all right, let's go for the next 3 months. They were feeling good, clearly. Over the last couple of years, they showed really good incrementals. They made a lot of progress in the business. They were feeling good. That was a mistake. And so, and then on top of that, if we look at like the low end consumer, so like ThredUp and other secondhand clothing players, they're like mass market and then like lower income component. Like it's like a lot of people who make decent money buy secondhand because it's like environmentally conscious, like all these different things. It's kind of trendy. But then there's also people who are just buying it because it's cheaper. And so in July, like in the summer, that low end customer was like deteriorating further. So then in August, when they came and reported Q2 results, they literally came with 3 presents filled with not things you want, to put it kindly. It's the macro being worse, causing incremental softness, so guide down from that. We're going to either close down or sell international because it needs more investment. So that's another hair.
And would Canada be lumped in that international bucket?
No, you can't. Okay. You can't shop in Canada.
Okay.
And then thirdly, and we also had this new marketing we had this new customer acquisition strategy that also made it so we acquired 90,000 less customers in Q2, which now is going to lower our revenue in Q3 as well because of like the cohort. Like it's like that's a loss that's just we're going to be eating that loss now, even though we've already fixed the problem. We're still going to like pay for it for the next couple quarters. Stock just got annihilated, and this was a very small position. This was like 2.5. Like I view small positions as like 2 to 3% weights. So this was a 2 to 3% position. All of a sudden comes out with these results. Oh, great. Stock gets annihilated. Obviously I talked to them, figure out like, okay, well, like let's start off with the international element. Like, are we actually done with this, or are we going to have like more capital commitments that are going to happen? Why did this happen to begin with? Obviously, like trying to figure out why this happened. Then you go into the marketing piece of like really understanding, is this marketing mistake? Is that actually what it is? Or is there like other stuff going on and this is the excuse that you came up with? And so I really pressed on their wounds pretty aggressively, which I thought that they responded quite well to, and just I thought had very logical, sensible answers to a screw up and how it would be fixed. And then they reported the next quarter. Things didn't get worse. things were actually getting better, and they commented on how, our new customer acquisition is actually improving dramatically. And we've sold and we've exited the international business. We only have to fund it with $2 million more.
Yep.
And we think 2025 is going to be the year now where we can kind of like show that this business is a cash generative, like good business that has a really differentiated moat. And so I have been buying a lot more the last couple months on this view that like, okay, comps are super easy in 2025. Also, the low end consumer has materially improved over the last couple months, which we've been able to evidence from several other consumer companies. And their net cash balance sheet, like it's good. It should like, there's not like this thing's going away risk, and it actually should be like this thing's accelerating with great profitability.
Yep.
And so then yesterday they pre-announced Q4, and what was initially guided to like -4% revenue growth at 1% EBITDA margin came in at 9% revenue growth.
Oh, that's a good revision. Okay.
And 6.5% EBITDA margins.
Yep.
So
they're
now
back on track.
Now they're back on track.
Having higher conviction. Yeah.
Now they're back on track. They should do it. Like they're gonna at least do, they should like they could do over 20 million of free cash flow this year potentially. It's a 200 million EV, but that's like it'd be 20 million this year and like 40 the next. Like in the next 5 years, it could get to like 100 million run rate free cash flow generation. It's a 200 million market cap company with net cash.
Yeah.
And so yeah, I know I probably took longer than you wanted there, but it's just such like a nuanced thing that happened in the last year that I think we're going to make a lot of money on that I'm quite excited about.
Well, super interesting because again, it's one thing to buy, but it's another thing to hold on these companies. I'm super curious though, Jordan. What was the discovery process? How the hell did you discover ThredUp in the first place?
Yeah, I'm always looking at new ideas that are businesses that are growing, like literally growing faster than nominal GDP, have management teams that own a good chunk of equity, and so like literally the amount of companies that have those characteristics, it's like a couple thousand. And I'm always just flipping through investor decks, and I've been doing that for years. So I've effectively looked at thousands of companies. And then some of them, after looking at them, you're like, this is an interesting business model. This is unique, and this founder seems quite intelligent, but there's a lot of elements that are like, I don't have an edge here. I don't understand this, or maybe that'll work, maybe it wouldn't. And then you just kind of forget about it and just follow it loosely, which is the case with ThredUp, where I think I met with them in 2021 and just followed it. And then eventually, you could have an opportunity where it's like, oh, the business actually is in a good spot now, and and everyone thinks it's dead, and I don't really see how that would happen. Directors are buying stock. If what they say they're doing right now is what's going to happen, we're going to make a ton of money, and so yeah, I'm just high volume of looking at new ideas, and then tracking them. Because usually when I buy something, I've been following it at least in some capacity for a couple of years.
Okay.
Because
there's a very big bench. Because
yeah, I have a huge bench, but it's like there's particular moments where the opportunity is there. It could be like 90% of the stock's life, it's like not that attractive, and then there's like a moment where it's like, oh,
yep,
this is
I'm trying to think for viewers how they can apply a screen at home, for example, right? The top of your funnel could be you're looking at higher than average revenue generators, right? So 20% or more. It sounds like quarter over quarter, year over year.
Usually, yeah. Like I would say, always double digit. Like I'm not going to buy a company if I don't think it can grow double digit 10 years from now. So if it grows 10% a year right now, and I think it's going to grow 10% a year in 10 years, I would still be potentially interested in that.
Okay.
But for viewers, I like. At the end of the day, like generating great returns from situations like this is about knowing something that in aggregate other people don't know or have a view on, and so I would say for those situations, it's probably your best situations are just companies that you understand.
Yeah,
it's not about the stock necessarily; it's about the company, like understanding its value proposition and why you're willing to like every good business is just a business where they're able to employ people at a good rate and sell stuff to people where suppliers of them make money and the consumer is happy to pay that price that
Yeah.
makes shareholders money and everyone money. So everyone's kind of better off. So uh, that's how I would think about it. That was how I looked at Uber. Is just like I was a consumer of it way before it went public, and
Yeah.
always thought this as a consumer is such a great value add. And I was covering technology at the time, so I understand marketplace businesses. Like this should be a very profitable business. Why isn't it? And then you dig into the reasons, and all of a sudden you're like, oh, this broad brush approach of saying this company's losing money is like it's actually not really the right way to think about it.
One easy observation I made from your roster of portfolio holdings is I think there's only one Canadian company in the fund. Tell us about why you're not as excited about Canadian companies.
Um, I'm not excited. I'm just excited about the companies I own, and so I don't look at companies thinking, oh, I'm going to look in Italy for companies.
Yeah.
That's how I operate. I'm just looking for what's a great business run by a really smart individual that's currently materially mispriced, where I understand it really well. But there are Canadian companies that I love. Like I think Shopify is an incredible company.
I was surprised not to see Shopify. I'll be totally honest.
It's an
Is there?
amazing
Did you
company
own
and
it?
one,
Sell it?
yeah. I owned it from
Okay.
like I think I owned it from like 2017 to like 2019, and so I'm just like one of those people that didn't make a lot of money on it, unfortunately. And then I was gonna buy it in 2022, and then I had these other names where the thing is like Shopify is such a great company, and it's so well known that it's a great company that even when it's
Mm,
sold off, it didn't get to the level that like Carvana and some of these other names
yeah,
were,
two times EBITDA,
where
right?
people are like, this business is an absolute piece of trash. Like no one hated Shopify that much
That much where you had like car dealers
where you're
calling you
like,
like, get out of it.
yeah, like like that is what has like held me back from owning it. But Shopify is like just a incredible company that I hope I own at some point. I really hope
Yeah.
I do.
Are there any other Canadian companies that are potentially on your bench that you could pull the buy trigger?
Um, there are. I don't really want to talk about them though.
Okay. Maybe for the sequel to this, maybe at the end of the
Yeah.
year.
Yeah, maybe. Yeah, that's true. Maybe the sequel, I'll talk about some other Canadian companies that there's many good Canadian companies. I am by far not a against Canada
Yeah.
person. It's just again, I gotta know it really well. It's gotta be a great opportunity, and it's like I'm looking for very unique situations, and
Hmm.
typically I'm going to like feel like I have a very material research edge on something. So that's why I end up getting pulled into these like very this particular thing happened that people sold because they're just like screw it, I'm out.
Hmm. They didn't really understand.
Yeah, they're
They,
just
they
like
don't
I'm
really
out.
understand the business. Yeah.
It's a 1.5 weight in my fund. This happened. Just get me out. And that's when I'm like, this implies this thing is an absolute turd. And I met with the CEO and I thought he was exceptionally bright. So I should dig into what's going on here. So that's why it's harder for me. Like it's like I could list a bunch of great companies, but it's like, do I think things people are complaining about right now are actually things that like I am like, no, that's wrong. Like
Yeah.
so
Have you met the Uber CEO?
I haven't met him in person. No.
Okay.
That's
You know.
the one element. So not every company I have like interacted with the CEO in person or even like over Zoom. For some I have, like Carvana, met Ernie. Um, have met most of my holdings. Uber would be the one that I have not.
Okay.
In terms of the CEO.
Yeah. Um, in your pitch deck, your investor pitch deck,
Yeah.
you've got a quote there. Volatility is not risk. This is very important
Yeah.
for investors at home. Can you break that down? Volatility is not risk.
Yeah. So obviously, like risk, the easiest way to define risk for the financial services industry is by ascribing it to volatility, and that is how it's been described. And volatility effectively means uncertainty. And so things that are more uncertain in general are viewed as more risky.
Mm-hmm.
And so that's a general rule of thumb. And I think and frankly, in general, it's probably right that in general, if things are more volatile, it means they're more risky because there's more uncertainty from the aggregate market participants.
Mm-hmm.
But on an individual basis, it frequently is not the case, because you could imagine a scenario where if there's two holders of a stock, in theory, there's one portfolio manager A and portfolio manager B, and portfolio manager A decides he wants out of this position, and he owns a big slug of the company.
Mm-hmm.
And it is in the period where the market, people are freaked out about something. Something happened, whatever. Some geopolitical thing happened. Everyone's freaked out. So and he's like, I got to sell this. He is going to sell a lot of stock into a market where there's just no one's interested in this company. And so the stock is going to go down dramatically, potentially. It might go down a lot in this theoretical scenario where there's only two market participants. And so you, as the other participant, might be like, well, I know exactly what's going on with the business and nothing has materially changed here. Or like, this business is going to do very, very well over the next 5 years, but over the next couple quarters, they might have some softness. I don't know. Regardless, people are dumping it. And so you're effectively, when you're saying volatility equals risk, you're effectively saying that market participants are always right, and they're always and they determine how risky an investment is. Their trading decisions. And that I just fundamentally disagree with. Like, that just doesn't make sense to me, how volatility would equal risk. Often more volatile situations are less risky on a longer term basis because everyone's pricing the security based on some sort of cyclical thing that's going to be applicable this year.
Yeah.
But over 5 to 10 years, it's not going to be applicable.
Mm-hmm.
So, like, it's less risky as a longer term investor than it was at a higher price.
Yeah.
So that is the, like, I definitely understand that people a lot of times people don't like to, oh, volatility doesn't equal risk, and then you own all these volatile securities. But it's based on the premise of, like, you know, if you believe in inefficient markets and that there's opportunity to find alpha, then I don't know how you could also believe that volatility does equal risk.
Yeah.
I don't know. I don't, like, if someone has the answer, I'd love to hear it, but I don't know how you could make that argument.
Yeah.
So yeah, that's why I think about it that way. So that's why I get pulled into these scenarios. And again, like, real alpha gets captured from understanding something better than the aggregate on a security.
Yep.
So a lot of times those painful moments for a company are really like the huge opportunities, where you could have an edge in your understanding of the business, where people are just making irrational statements. They're just like, I can't defend this any longer. I've been telling my boss to buy this thing for 4 quarters, and I can't deal with another negative. I can't deal with saying it hasn't accelerated yet 1 more quarter. So I take advantage of those moments, and I've been able to, with the Carvana situation, with ThredUp situation, with a lot of different holdings. Like, 2022 was just a year of opportunity in a lot of great businesses, to pick them up for cheap prices. So that's
it was a blessing in disguise, right, to start that year. As we talked about, 2024 was a very good year for you. You're one of the top fund performers in Canada. Congratulations.
Thanks.
You're up over 80%.
Well, I didn't end up there. I was there as of the end of November. I ended up about 67% in 2024.
Okay. Well, it's still notable. It's still, top tier. Looking into 2025, Jordan, What do you think are going to be the top 5 contributors to the fund's performance this year, if you were to have a crystal ball?
I think it's going to be Carvana, HelloFresh, Wayfair, ThredUp. What am I going to pick for my fifth? Let's go with Latham.
Okay, Latham.
I think
Okay.
that those will be it. Like Carvana is going to keep like Carvana right now is just a money making machine. And if you were to ask a majority of portfolio managers that work at like large firms and run large cap quality company funds, pretty like I I'm gonna like a very very small percentage of them will own Carvana first off,
Yeah,
and a solid percentage will say I've actually never done the work.
that's a good opportunity for you. There's
So
still so much
I was at I was
potential.
at a dinner recently where I said like I'm gonna make a bet right now that a year from now, all of you guys will have done the work because a year from now the financial profile of the business will be so attractive that you won't not be able to do the work. Like they are
Get that
growing.
extra lift,
They're
right?
the
Everyone's coming in, and
they're
yeah,
by far the fastest growing of their industry. They have 1% share of the industry. They're by far the fastest growing. They're double industry profitability. Like, so it's not like, oh yeah, it's fast growing, but the unit economics are good. Don't look at the income statement right now. It's not even that. It's oh, it all looks good. Everything looks fantastic right now, and it's just about scaling. And so because we're still like it's still pretty recent that it was like scary. And then the Hindenburg short report that came out earlier this year is just another reason for someone to be like, oh, I'm not going to
yeah,
look at that.
yeah.
But a year from now, the economics are just going to be so powerful. I think that like every large cap manager is going to have looked at it because it's just an incredible company run by an incredible management team that got caught
Are
up
they
in this
operating
insane
in
short.
Canada right now? Like, can you buy
No,
a car through Carvana? Okay.
no, it's a reason why I love them. Frankly, is that people always, oh, you're going to go international, and they're like, the U.S. is enormous,
Yeah.
and so we need to be focused on just doing what we're doing, which is win the U.S.
Yeah.
When they do that, coming into Canada at some point will literally be like it won't even matter because the U.S. is just so big.
Yeah. So you're also the meme king on LinkedIn right now. I think you're sending out a meme every day at one point, Jordan.
Yeah, but
I think
I've taken a
November
breather.
through December. Hey,
I've
there's
taken a,
one.
I've taken a
Yeah,
breather recently, but
exactly. You
yes,
gotta take a breather,
I
right?
was
There's
on a
one with
heater.
Leo, I think, from Titanic in one of the memes, and you're obviously promoting the fun and the good performance. But tell us about that. Tell us about
The memes?
yeah, tell us about the memes.
Well, I think they're funny. Well, number one thing, as you can imagine, I have met a lot of really successful entrepreneurs. Some of them
Yeah,
I'm very, I guess, proud to say they're friends of mine, and their advice to me has always been, always be yourself.
yep,
And your tribe will find you through being
yep,
yourself.
yep.
And so I've just kind of run with that advice of just being myself. And so I guess that makes it so that maybe I say jokes in some scenarios where maybe some people wouldn't like me to make a joke, but it's how I've been operating, and if
Yeah.
I just think it's funny, then I say it, and obviously everything is about the fund, and I find more people are interested in learning about stuff if it's interesting,
Yeah.
and nothing's less interesting than your average financial services marketing.
Oh, it's good fun. I think people should follow you just for the memes. I think, right? Like, just check out Jordan's LinkedIn, and you have a very big advocate. I'd love to know who this person is. It's Mo Nazarati. Is he an investor in the fund? Like,
Yeah, 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 yeah.
he's one of your biggest fans. So
Yes.
tell me about him.
Yeah, Mo's a great guy. He's a successful entrepreneur, sold a
Yeah,
business several years ago, software business. I met him actually through uh, someone who was a co-op when I worked at Cambridge Global Asset Management.
yeah,
One of our co-ops I had kept in touch with, and he told me like, "Oh, my uncle's like big tech guy, made a lot of money, sold a business, and you should talk to him about business." So I met him through that, and pitched him. I met him when I was down 50. So I met him at my low when no one
Yep.
wanted to chat with me or meet with me,
Yep.
as you'd imagine.
Mm-hmm.
And he was interested of meeting, and we got chatting, and then he invested in the fund, and we've just kind of like built a relationship since then, because he's, when you tell someone to buy Carvana at $7 and it's 200 now, like he's like he was one of the few people to
Yep.
actually
He,
hear the information.
he had the same vision,
Yeah, he's great.
and
He's
these are the
awesome.
ideal investors you want in the fund, people who will stick it out, right?
Yeah, it's
Permanent
about like the fund
capital and
today is
believe in the
just all
companies.
mostly like a couple advisors
Yeah.
and other people who are, entrepreneurial people that get what I'm doing, which is just looking to generate strong returns over a 5-year basis by owning great companies run by great people that might be really out of favor for particular reasons that I understand really well. And so it's going to be, it's a more volatile fund than, your typical bank's North American equity strategy. Um, but I believe it's going to generate better returns over time, and that's what it's been so far. So,
Yeah. Last question, Jordan. This has been a lot of fun. Before you pull that buy trigger on a brand new stake in the fund, what's that final question you ask yourself in your head before you say, okay, I'm going to commit, 3, 4, 5% of the fund's capital to the company?
there's not a final question. That'd be to say that there's like one question I ask, look myself in the mirror and think, is this the like? There's not one question. It's always there are a few questions that are the uncertainty, insecurities of the thesis.
Okay.
These are the things of the thesis that have to be true for this thesis to be 50% right. You know what I mean? Like it has to, it's for, like, there's obviously a lot of different like micro assumptions that all could incrementally add or minus 5% upside, but there's like some core part of the investment thesis that needs to be true.
So
And
you're
so
looking
for
at,
every
at
company
poking
you would
holes,
keep
for
track.
example,
Sorry?
potentially. So you're basically looking to poke holes
Oh
in the
yeah,
initial
yeah, that's all you're
thesis to
doing.
see, okay, yeah,
That's all you're doing. That's why I say I'm the most negative optimist because all I'm doing is complaining about all the things that could screw the portfolio and obsessing over them. But
well, that's
yeah,
great.
that's what I'm always doing. It's like with certain businesses, it's like, oh, well, the unit economics have to scale
Yep.
as they have the last few years. If there's a reason that they've hit a threshold where now incremental returns are going to deteriorate, then like this bull thesis is not going to be correct. And so there's always going to be some sort of like insecurity in every investment thesis. So pretty much I'm walking around with that thought all the time, and then I'm always looking for evidence that puts me in one direction or the other as to whether I'm more confident or less confident that my view is correct.
Yeah. Well, I'll be watching the Optimist Fund closely throughout the year, and we'll catch up at the end of the year.
Awesome.
Jordan, I wish you the best of luck and
Yeah,
success.
I enjoyed the chat. It was fun.
Sounds good. Talk soon. Have a great one.
Bye, Robin.